Hello and welcome back. Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about receivables. Receivables. Receivables are considered to be anything that the company expects to receive from their customers. Yeah? Ooh, I like receivables. Okay, receivables. You know the word accounts receivable. Accounts receivable are the funds that we expect to collect from our customers. Another one is called notes receivable. A note receivable are funds that the company expects to receive from our customer that have been shifted from an accounts receivable to a notes receivable. Typically includes interest. It's like a short-term loan that we made to our customer, essentially. Yeah. Another way to think about that is like a store credit card, right? That's another example of a notes receivable for the store. We'll talk more about that. Word receivable means money claims against other entities, including people, companies, and other organizations. Notes and accounts receivable are the most commonly used. We call these another name for notes receivables and accounts receivables. Another name for that is called trade receivables. We don't use that word that often, but it's another name. You know how that goes. Accounting's always got it's multiple names for the same thing. It's the same way in finance, It's just over the thousands of years that we've been covering accounting, it's changed a lot with the names. Okay. Most common transaction on creating a receivable is we sold merchandise to a customer on account. A company will oftentimes sell merchandise or services to their customers on account, meaning we have provided the service or delivered the product, but the customer has not yet paid us. Therefore, we call it on account. It's on their account, right? Ultimately, the customer will pay us. So when I sell something on account, I debit accounts receivable and I credit sales. I debit accounts receivable and I credit sales when I sell something on account. Normally, the customer will pay me within 30 to 60 days. When the customer pays me, eventually, within 30 to 60 days, hopefully less, we debit cash to increase our cash, and we credit accounts receivable to reduce the accounts receivable. Remember, accounts receivable is a temporary, contra account, right? Contra account. What about notes receivable? Notes receivable are the amounts that customers owe us in a formal loan, also known as a written instrument, formal loan of credit that has been issued. This also could be a line of credit, same thing. If a notes receivable are expected to be collected within a year, it's a current asset. Remember, a year or less is current. Longer than 1 year is long-term. So if I expect to receive a notes receivable within 1 year or less, it's under a current asset on the balance sheet. Notes receivable are used for credit periods for more than, I think it's like 90 days, right? 60 days on average. So if a customer owes me something and it's longer than 60 days, I usually classify that as a notes receivable. Because it's an example of this would be like a store card. I purchased furniture using my Bob's Discount Furniture store card. I pay the store card once a month, and I expect to have it completely paid off within less than 1 year, because that's the term, right? For Bob's Discount Furniture, they record that as a notes receivable from me, the customer. Because it's greater than 60 days. Yeah. Notes may be also used to settle customer accounts receivable. sometimes a customer might fall behind in their accounts receivable. They haven't paid it within 30 days or 60 days. And so the business will say, hey, listen, I'm going to convert your accounts receivable to a notes receivable. I'm going to charge you some interest. Other accounts receivable include things like interest receivable, taxes receivable, receivables from officers or employees. These are a little bit more rare, but they happen. Interest receivable, if the company has a bank account and they collect interest from that bank account, it creates what we call an interest receivable. Or if we have a customer that is paying us monthly and there's interest associated with that, we create what's called interest receivable. Another example, taxes receivable. I expect to collect sales tax from my customers that have not yet paid the sales tax. That would create a taxes receivable. Or another example would be, I overpaid my taxes this past year. I expect a tax refund from the IRS. That also creates a tax receivable. Receivables from officers or employees. Sometimes the business will be really super nice and awesome, and they'll provide their employees what we call a advance on their paycheck. Employees have to repay that advance. Therefore, we call it a receivable from officers or employees. Or the company might lend the officers or employees money, right, as a loan, a short-term loan, and they expect to be repaid within 1 year. That would also create receivables from officers or employees. Other receivables are normally reported separately on the balance sheet. There's usually a note too, telling you what it is or what it was for. That's why accounting notes are really, really important. Issues with selling on credit or on account. Sometimes the customers don't pay you. You know what I mean? It's like, oh, I sold you that phone from my store. On account, you said, hey, I'll pay you back in 30 or 60 days. Great. And then
Dr. V.
And then you don't do it. Yeah, go ahead, Richard.
Sorry to interrupt, but
okay.
So I've heard the term that many people prepay taxes in advance.
Yeah, I do.
And then people are surprised when they pay, like less taxes than them in the future. Let's say they pay like millions now, then in 5 years they don't have to pay anymore. So I have like the idea, but could you please like elaborate on that?
Yeah. No, I'm glad that you brought that up, Richard, because that's something I typically do, because what happens is that almost every year I always owe the IRS. Somehow, some reason, I don't know. I've tried to figure out why it is, but sometime every year I owe them something, usually a couple $1,000s. So when I file my taxes, they'll tell me that I need to make quarterly estimated payments throughout the year in order for me not to owe them for the next year. We call these prepaid taxes. Okay, prepaid taxes. I'm paying for the year in advance. The reason why people do that is to avoid penalties from the IRS, because they'll charge you penalties. Believe me, they will. I hate the IRS so much. They will charge you penalties. So that's one of the reasons why people prepay their taxes, to avoid penalty from owing them too much. Okay. Sometimes people will say, you know what, I'm going to prepay into the future so that way I never have to owe them again. Right? They avoid having to keep owing the IRS by prepaying a lot up front. And it's not just wealthy people that do that. I do that. I'm not wealthy. I'm far from it. Um, most people do this, especially if you typically owe the IRS. So it becomes a prepayment of taxes. A prepayment of taxes is technically an asset. As you learned in way back when, I think it was like in chapter 2, anytime there's a prepayment of anything, it's considered an asset account. Reason being is because you could always get that back. You could always say, you know what, I'm not going to prepay that. They'll have to pay you back, right? So that's the idea behind it. Richard, does that help to answer your question?
Yeah, it really helps. Thank you.
Awesome. You're welcome. So yeah, I always recommend that you prepay your taxes whenever you can, to avoid Uncle Sam charging you even more. That guy, let me tell you. Okay, sorry. When you sell to customers on account, sometimes they may not pay you back, or they may not pay you for the merchandise or for the service. Well, you know how that works. Oh yeah, I meant to pay you, but I forgot, or oh, I never intended to pay you back. Things happen, right? So the company will shift the risk. So what does that mean? When I sold the inventory to the customer on an account, I debited my accounts payable and I credited my sales. A couple months passed. Guess what? Customer never paid me. A couple months more passed. Still no payment from the customer. Now I'm getting nervous, right? And toward the end of the year, I know that customer ain't going to pay me. So we established a couple of accounts that I'm going to talk about here shortly, called uncollectible accounts. We'll talk about it. Uncollectible receivables. This is the risk that we run when we sell on account, is that the customer may not pay us. And so what some companies do is they only accept cash or credit. They don't do accounts receivables because of that risk, right? I mean, the risk isn't that huge. It's usually like 3% on average of your customers that won't pay you. That can be huge if your company's huge, right? It's usually about 3% on average. Some companies will even do what we call factoring. This is where the company will sell their receivables to a third party. You all probably know them as creditors, credit agencies, debt collection agencies is what I'm trying to say. Sometimes a company will say, you know what, this guy hadn't paid me for this stuff. I'm all mad, but I want him to get some money, so I'm going to sell that debt to a collection agency. Collection agency going to pay me 25 cents on the dollar, and the collection agency will try to go after the customer for the rest, right? That's what happens. We all know. I've been there. I've been on that other side where they call me and be like, hey, you owe me, and ba. You know how that works. But they call it factoring. Yep. It's where the customer, the company will say, hey, listen, I'm going to sell this debt collector the debt. They'll pay me the difference of the receivable. The benefit for companies doing that is it provides cash flow right away, and it helps the company for their operating needs. So, but regardless of how the company approaches that, the sale is still uncollectible. And because of this, we have to record it. We record it as a bad debt expense. This is where we take it out of accounts receivable and put it into bad debt expense. We expense the receivable out because we can't collect it. The account's name is typically called bad debt expense. Sometimes it's called uncollectible accounts expense or doubtful accounts. Well, typically I call it bad debt expense. Yeah. Indications that your customer may not pay you. The receivable becomes past due. That's usually a red flag. Customer doesn't respond to company's attempts to collect the debt. Company calls you, company sends you letters, company emails you. You know how it is. I know, I see you. Don't worry, I've been there. I've done it. Sometimes the customer might file for bankruptcy. They can't collect from the customer. The customer closes their business. The customer cannot be located. That's one of my favorite ones. The customer moves and change their phone number, all that stuff. So what do? We have to write off the debt, right? So when you hear the word write off, it's usually good for the company's taxes, right? That's why they do a lot of write-offs for purchases or for other things. In this case, we write off the bad debt. We debit. Now remember, here's how it works. When we made the original sale, we debited accounts receivable and we credited sales. Now we can't collect from the customer. We can't find them. They changed the number, whatever. Now what do we got to do? We got to debit bad debt expense and credit accounts receivable. At the end of the year, I can write off my bad debt expense through, there's two methods to do it. The first one is called the direct write-off method. This is where we simply record the bad debt expense and it's deemed worthless, right? The other method is called the allowance method. This is where we record the bad debt expense by estimating the amount that we probably won't be able to collect from all of our customers at the end of the accounting period. Estimation, earlier I said 3%. Usually I cannot collect about 3% of my customers what they owe me. That's an estimation. That's what we call the allowance method. And through generally accepted accounting principles, I can estimate based off of all of my accounts receivable that I'm not going to be able to collect about 3%. And so I would debit bad debt expense by the 3% of the total accounts receivable, and I would credit accounts receivable. And then if I do end up collecting it, I can reverse that. But here's an example. We have a customer, Mr. Ross. Mr. Ross purchased $4,200 of stuff from us for his company. Mr. Ross disappeared. Never paid us, right? So we have to reduce his accounts receivable and write it off as a bad debt expense. This is the direct write-off method. So we debit bad debt expense, $4,200, and we credit Mr. Ross's account, the accounts receivable, $4,200. Accounts receivable that has been written off may be collected later. Sometimes Mr. Ross might wake up like almost a year later and be like, "Oh, I'm so sorry. I forgot to pay you, 8 months ago. So here's your cash." Okay, so you can reverse that entry. You could reverse that earlier entry by simply making an adjusting entry and reversing the entry. You would, in that case, re-debit the accounts receivable and you would credit the bad debt expense. So, as I said, you would re-debit the accounts receivable and credit bad debt expense to reduce the bad debt expense because Mr. Ross woke up and decided to pay you. And then you would debit cash, credit accounts receivable. So those are the two entries that you have to make when Mr. Ross wakes up and pays you. The stuff happens, it happens. Time. What about the allowance method? So, in this example, using the allowance method, our company had a receivable balance of $200,000. We estimate that about $30,000 of that $200,000 will not be collectible. So by the end of the year. So what do? Based off that estimate, we debit bad debt expense by the $30,000 and we credit allowance for doubtful accounts. by the 30,000. The allowance for doubtful accounts is the account that we use when we're estimating the amount that we won't be able to collect from our customers. Does it make sense? Also with me? Lynette, did you have any questions on this, or is it pretty straightforward, do you think?
It's pretty straightforward.
Great, wonderful. Yeah, I know sometimes it could be a little complicated, especially the way that it's written, and the account names can be a little confusing sometimes.
I do have one.
Yeah, go ahead, Richard.
Regarding the allowance method, it was like not so clear for me.
Sure.
Can you please like circle back?
Yeah, absolutely, my pleasure. So for the allowance method for uncollectible accounts or doubtful accounts, the way it works is larger companies typically will estimate that a certain percentage of their accounts receivable won't be collected. You know, things happen to customers, they disappear, they don't pay the bill, whatever. So what we do as a company is we estimate that a certain percentage won't pay. And so to record that estimate, we debit bad debt expense and we credit the allowance for doubtful accounts. That's the idea. It's an estimate, right? So in this case, our company's estimating we won't be able to collect about 30,000 of the total 200,000 from our customers. Does that help to clarify it a little bit for you, Richard?
Yes, it does. Thanks.
Great. My pleasure. My pleasure.
I have a question, Professor.
Yeah, Pavle.
Do we need to like charge, for example, for that 4,200, whatever the amount was, do we need to charge that person like some interest rate or not?
You don't have to. Some companies might, you know, you don't have to. But yeah, some companies might do that. They might be like, hey, you know what, but the thing is, you have to if you're going to do something like that, you need to disclose it in the agreement up front. You know, you need to disclose that to your customer up front if you're going to do something like that. You could. Good question.
Just like to add on that, on the when companies are able to collect the debt, what happens when a company sells their debts to collection agencies?
Oh, yeah.
Yeah, great question. So it's pretty much the same process. So if the company realizes, you know what, it's been a year, there's no way this customer is going to pay me, I'm going to sell this debt to a collection agency. The collection agency will probably pay the company a fraction of what the actual debt is. So if a customer owes me $4,200 and there's no way I'm going to be able to collect it, I sell it to the collection agency. Collection agency is going to pay me like, I don't know, $500 maybe. So it works pretty much the same way. So you would debit accounts receivable $4,200, credit bad debt expense $4,200. I'm sorry, this is when they paid, right? So you would debit bad debt expense $4,200, credit accounts receivable $4,200. Then you would debit cash $500, and you would credit bad debt expense $500. That would be the entering. Yep.
Thank
absolutely.
you.
Yeah, my pleasure. Yeah, once in a while that happens. It's not as frequent. Yeah. Good questions. Allowance for doubtful accounts. You heard me say this earlier. We use this account when we're estimating that a customer is not going to pay us, right? So since we don't know which customer's account will be uncollectible, you typically do like a percentage or a fixed dollar amount as your estimate. And we use this account called allowance for doubtful accounts. That's where we enter the amount that we think will be uncollectible. And we credit that account. So just as we saw from this earlier example, you debit your bad debt expense and you credit allowance for doubtful accounts when you're estimating the amount that you won't be able to collect. And there's a bunch of different ways to do that. In this example, we simply factored, $30,000. In most cases, we typically take the total amount of accounts receivable and we multiply that by a percentage. Earlier I said in most cases our company cannot collect 3% of all of the accounts, right? So I would just take my total accounts receivable and multiply that by 3%, and that would be my allowance for doubtful accounts. It's just one method of doing it, or one way of doing it. There's no like fixed policy or rule or law about the way that works. It depends on each company's policies. Some companies don't even do it. Some companies don't even bother to write it off. It depends. The preceding adjustments. Okay, so these are adjustments we make in the balance sheet. Just as you saw before, you debit bad debt expense, and you're going to credit the allowance for doubtful accounts. There's another term here that you should know. It's called net realizable value. Net realizable value. This is the amount that we know that we can actually collect. So net realizable value is the amount of receivables that we know we can actually collect. And so the way to figure out what is your net realizable value, you take your accounts receivable minus your bad debt expense. Accounts receivable minus bad debt expense to equal net realizable value of your accounts receivable. Write-offs and allowances. When a customer's account is identified as uncollectible, we write it off against the allowance, the allowance for bad debt. So debit, bad debt expense, credit accounts receivable, right? This requires the company to remove specific accounts receivable and equal to the amount of the allowance account, which we talked about. So so in this case, we have a customer, John. Oh, John, what's going on, buddy? He didn't pay us. So we debit allowance for doubtful accounts, and we credit accounts receivable for that customer. Because allowance for doubtful accounts is based off of an estimate, we'll normally have a balance at the end of the period. As a result, we write off that balance. The allowance for the account will have a credit balance, and if it's less than the beginning balance, and it'll have a debit balance if it's more than the beginning balance. It gets a little complicated. I mean, you don't have to worry too much about it. We're not going to dive too deep in this class on this, but it's just important to understand how the concept works. I don't like that graphic. It's kind of terrible. It's my opinion. We don't need to go over this. I don't need to go over that. We're done with that. Okay. Estimating uncollectibles. As I said earlier, there's a couple of ways of going about estimating your uncollectibles. I typically use a percentage of all of my accounts receivable, about 3%. How did I get 3%, you might ask? Well, for my company, it's based off of the industry average. There's a couple different ways you could estimate it. You can estimate your uncollectibles by looking at your past experience, the industry averages, and the forecasts in the future. There are two methods for analyzing this: as a percentage of sales, which is what I typically do, and an analysis of receivables. Using percentage of sales, we estimate based off of our sales when we attach a percentage of that we're not going to be able to collect. The earlier example I gave is 3%. Here's an example. We assume that this company, before any adjustments, balance of accounts receivable, $240,000. Balance of allowance for doubtful accounts, $3,250. Total credit sales, $3 million. Bad debt is a percent of total credit sales, 0.34%. 0.34%. That's why it says 3/4, 0.34%. So I expect that we won't be able to collect 0.75% of our total accounts receivable. So the estimate for our bad debt expense is $22,500. How did we get that amount? We took our total credit sales, total accounts receivable, times the percentage that we estimated, which is 0.34%, equals $22,500. $22,500 is the amount that I estimate that I will not be able to collect. So the journal entry we make for that is bad debt we debit bad debt expense, $22,500, and we credit the allowance for doubtful accounts, $22,500. Percent of sales method, in my opinion, is probably the easiest. I think it's the easiest. Okay. Now the other one, the allowance for receivables method. Allowance for receivable method, it assumes that the longer an account receivable is outstanding, the less likely it is that we can collect on it. That's pretty obvious. You know, after it goes past 30 days, goes to 31 to 60, 61 to 90, 91 to 120, 120 plus. Once it gets to 120 plus, there's no way. I mean, you're not going to collect that. Come on. It's been so old now. We'll talk about it. The analysis of the receivables method applies to the following. We take step one. We look at the due date of each account receivable. Step two, we look at the number of days each account is past due. Step three, we place each account into what we call an aging report. Aging report. I'll show you what that looks like. In step four, we total up each age class in the aging report. Step five, total of each age class is multiplied by an estimated percentage of uncollectible accounts. And step six, the estimated total accounts, uncollectible accounts is determined by the sum of each uncollectible amount by percentage. This process is called the aging of the receivables. Now, I want to show you what it looks like. This example is perfect, okay? Here's how it looks. On the left column, you see all of our customers listed out. In column B, we see their balances, how much each customer owes us. Column C, it's not yet past due. So it's current, in other words. And what we do is we apply a percentage of uncollectibles based off of how old it is. How old it is. You see on step 1 through 3 is we add up our balances for each column. That's step 4. We add up all of our balances for each column. That's step 4. Step 5. Step 5, we apply a percentage that we expect will not be collectible. You can see that for ones that are current, we have 2% that we won't be able to collect. 5% for 1 through 30, days 1 through 30 that are past due. Days 31 through 60 that are past due, 10% we won't be able to collect. 61 to 90, 20% won't be able to collect. 91 to 180, 180, oh my God. 30% we won't be able to collect. 181 to 365, okay, a year, right? 50% won't be able to collect. Anything over 365 days, 80% of that I won't be able to collect. Again, these are estimates, right? The percentages are estimates that we expect we won't be able to collect. So the way it works is you take the sum of each column and multiply it by that percentage that is uncollectible, which gets us to step 6, is the estimate of uncollectible accounts. You add up each one for the columns and you get a total balance. In this example, we expect throughout the year, we will not be able to collect $26,490. That is the aging of receivables. Questions? Does it make sense? Is it straightforward? Lynette?
Yes.
It makes
Can
sense.
you-
I definitely go back and give it a look over, but it makes sense.
Great. Lynette, you're good?
No.
Okay.
we're,
Tell me. It's okay.
I'm sorry.
It's all right.
The 64,000. How do we get that? I'm just curious.
64,000.
On the total, on the days 1 through 30, 64,000. Where does that number come from? Because I see the balance, you add all of them up for a total, which gives me a total of 240,000, right?
Oh, sure. Yep. You add up all of your
So-
customers, lines 4 through
So as
22.
as the days go by, where's the total coming from?
Yep. So it's coming from each column as the days go by. So for column C, this is my amount that's current. I have 125,000. In other words, that's not past due yet. Days 1 through 30 past due. In that column, I have a total amount of 64,000. These are coming from lines 4 through 22. 4 through 22, that's a list of all my customers. Okay? You see there's a little wave in the middle there. That's because it's so long, right? We can't fit it all on one slide. But that's like the total amount for each column, yeah? And so those are the totals, right? And so I take that total amount, multiply it by the percent I expect I won't be able to collect, and that gets me my estimate of uncollectible accounts for each column. And I add all those up.
Okay.
Does that help?
Yeah, this is
Great.
a make believe. Okay.
Cool,
Got it.
cool. Yeah. It's a fun report. You know, it's really helpful, especially if you have customers that have owed you money for a while.
Hey, Professor.
Yeah, go ahead.
So basically, so it shows you as how the time goes on, the percentage of uncollectible accounts go up as time go on. Like the money decreases as.
You got it. Yeah. Yeah. So the idea is that, the older the account gets, the less likely it is you're going to be able to get the
So-
money from the customer.
So that 240,000
Yes, sir.
after a year will be down to 14,000.
After a year, you'll be down to 26,000 is what you'll be able to collect, or won't be able to collect.
Back right there, okay, to the
Yep.
total number. Okay, I see it.
You got it.
Because 80% of the money be down. Okay.
Yes, sir. You got it. Mm-hmm. Good. Yeah, it's a good report. I like it. It's really, really useful. Really useful. And it helps us a lot to identify how much we won't be able to collect as time goes on, just as we talked about. That's what this kind of tells us. So what do I do at the end of the year? I need to do an adjusting entry. I debit bad debt expense and I credit allowance for doubtful accounts. Just like before. The only difference is I'm using the aging report to help me with that. Okay. This slide's too confusing. I don't like that one. This is just another example. Oh, this is comparing the two. Okay. This is kind of a comparison between the two. You can see that we get to pretty much the same amounts over time. Direct write-off versus allowance method. So, I mean, really, they both have their benefits and their drawbacks. Okay. Notes receivable. Notes receivable has its advantages as well over accounts receivable. Note receivable is basically a loan that we made to our customer, short-term loan, right? It's like saying, "Hey, customer, you have 90 days to pay your purchase that you made from us, and I'm going to attach an interest rate, typically, yeah." And it's kind of like a loan. It's like a short-term loan, also, or it could also be like what we call an equity loan. Basically, what it is it's a way to tell customers, "Hey, I'm real serious. I want to collect that money from you." Promissory notes usually included, so you got to do some legal paperwork to get that store card, and there's usually an interest rate associated with it, and there's due dates, and there's a full amount due date. That's the idea of a notes receivable. And on that loan, you're going to have the maker, the payee, face amount, issuance date, maturity date, the term, and the interest rate. These are all factors of a loan. The maker is who is the party making the promise to pay. The payee is who is paying the loan. The face amount is the dollar amount that the loan is for. Issuance date is when the loan was issued. Due date is when it's due, also known as the maturity date, or when it should be paid off by, right? The term is how long it's for. And the interest rate is how much interest is expected to be collected on the face value. Now here's an example of a loan. You got your typical stuff. You got the signature, who made the loan. You got who it was paid to, the face amount, the issuance date, when we made the loan, right? When it's due, when you got to pay the loan back. The term, how long you have to pay it, and the interest rate. 10% on 90 days, that's pretty high. Just saying. So, okay, this just kind of shows you how we got to 90 days. If it was issued in March, 31 days in March, minus the date it was issued on, March 16th. That's 15 days in March, plus 30 days in April, plus 30 days in May. It's due June 14th, 14 days in June, gets you to 90 days. Here's how it looks graphically. 15 days in March, 30 days April, 31 days May. June, it was due June 14th. It was issued on March 16th. That's why there's only 15 days in March. So the loan term is 90 days. Interest rate, we said, was 10%. So how do we figure out how much interest we're going to pay total? Take the face amount times the interest rate. Okay. So 2,000 times 10%, what, $20? Or is it 20? Right? Yeah. Times 90 divided by 360. 90 divided by 360 is the term divided by 360 banking days in a year. Banking days in a year equals $50 will be the total interest amount for that loan. To simplify it, 360 days is a common practice for businesses because there are only 360 banking days in a year. That means there's 5 bank holidays every year. Maturity value is is how much will be paid back total. In this case, $2,050. It's the face value plus interest. When we account for notes receivable, promissory note may be used by the company to replace an accounts receivable. In other words, sometimes the company will convert a customer's accounts receivable into a notes receivable in the event that it comes past due and they're having trouble paying, so we'll turn it into a short-term loan. It happens from time to time. In this example, we have a company that owes us money, so we converted their notes receivable, their account receivable to a note receivable. So we said, hey, you got 30 days to pay us at 12% interest to settle your accounts receivable with us because it's past due. So the balance of what they owe us is $6,000. So the first journal entry I make is I debit notes receivable to increase notes receivable by $6,000, and I credit accounts receivable to decrease that customer's accounts receivable by $6,000. This entry represents converting from an accounts receivable to a notes receivable. So the due date comes around, okay? So due date comes around on December 21, 30 days later. The loan's now due, so the customer pays us. They paid us a total of $6,060. How did they get $6,060 instead of $6,000? Well, they owed us the face value of $6,000, and there was $60 interest because we said it was 12% interest for the 30 days. So how we figure out the interest rate, you might ask? We take the face value times 12%, which is the interest rate, times 30 days divided by 360, because there's only 360 banking days in a year, gets us to a total amount of $60. So $6,060. We receive $6,060, so debit cash $6,060. We credit notes receivable of $6,000, because remember the face value was $6,000. And we also credit interest revenue. We earned $60 in interest. So therefore we credit interest revenue, $60. Questions? Make sense? Good, right? Okay. Once in a while, a customer may dishonor the note receivable, meaning they don't pay back the short-term loan to the company. Well, that does happen from time to time. So what do? Well, we could either write it off or we can transfer it right back to an accounts receivable. To transfer it back to an accounts receivable, you just make the reversing entry. Debit accounts receivable, credit notes receivable, credit interest revenue. Company receiving a note should record the adjusting entry for any accrued interest during the period. And that's what that example looks like. Debit notes receivable, credit accounts receivable. And then at the end of that respective period, in this case a month, we debit accounts receivable, credit interest receivable. Interest revenue for the represent the accrual of the interest. And in this example, we're receiving cash payment from the customer from the loan that we issued to the customer. You debit cash, credit notes receivable, credit interest receivable, and credit interest revenue. And here's what it looks on the balance sheet. Almost done. 3 more slides. Okay, ratios. In decision making, as a manager, we analyze this data using ratios. That's, standard practice. One of those ratios is called the accounts receivable turnover. This tells me how quickly I am turning my accounts receivable into cash. Very important ratio because we got to turn those accounts, right? Got to get that cash. So this is a very simple ratio. Accounts receivable turnover. We take our total sales found on your income statement, right? End of the year, income statement, total sales. That's your total revenue. Divided by average accounts receivable. How do we find average accounts receivable, you might be asking? We could take your total accounts receivable, I apologize. You take your beginning of the year accounts receivable plus your end of the year accounts receivable, and you divide by 2. Why divide by 2? That's how you get an average. Is you divide by the number of factors, right? That's how you get an average. So beginning of the year plus the end of the year divided by 2. That gets you your average account receivable. So sales divided by average accounts receivable. Sales divided by average accounts receivable. Average accounts receivable, take beginning of the year plus the end of the year divided by 2 for accounts receivable, yeah? The other ratio we use is called the number of days sales in receivable. It's very similar to the one from the previous chapter. This tells me how long accounts receivable have been outstanding. Obviously, the higher this one, the worse it is. Yeah. So we take the average accounts receivable divided by average daily sales. Average accounts receivable, as you know, is the beginning of the year receivable plus the end of the year receivable divided by 2. To get average daily sales, we take our total sales divided by 365. To your average daily sales. This nice graphical representation of comparing it from year to year for the company. Yeah. And there we are. That is the end of receivables. Are there any questions at all on receivables? Any questions at all on receivables? We're okay.
No, sir.
Great. Thanks, Mike. Appreciate that. Okay. Now, to recap, what do you have to do this week? Oh, and if you're missing any,
The finals. I mean, not the finals. The midterms and the quiz.
you and the discussion board, right?
Oh yeah, and the discussion board.
I got you, Brandon. Okay, so yes, there are 3 items for this week. Usually, that's just 2. You typically have, a homework and a quiz or something along those lines, right? This week, you have your discussion board, your Chapter 8 quiz, and the midterm exam, okay? It's all due by Sunday night. Do not wait until Sunday. Okay, that is very dangerous. Very, very dangerous. Don't do that, okay? Don't do that. Because you can't take the midterm exam past midnight on Sunday, all right? So you can't go into Monday on the midterm. It's just not going to happen. It's going to shut down and lock you out. So don't do it. Okay. So here's the deal. For the discussion board, what am I looking for? What am I looking for on the discussion board? You go into the discussion board with discussion boards. There is a rubric. There is a rubric for every discussion board. The rubric tells us a couple of different things. Comprehension, timeliness, engagement, and writing mechanics. Okay, comprehension. I'm looking for about 150 words. Okay, at least. It should be more than that. 150 words for your original post. Try to include references and citations. You got to tell me where you got the information from. Very important. References, citations, about 150 words for the original post. Please try to have your original post done by Thursday night. Why by Thursday night, you might be asking? You need to respond to 2 or more of your classmates in every discussion board. And it's not just oh, that's nice. Oh, that's a good post. No way. That's not going to fly. Your responses to your classmates also need to be about 150 words per response. Full paragraphs here, people. You're all adults now.
50 words on there.
Oh, no. 50? You sure about that?
I got a question about that, Professor. Go ahead, Dave.
Response, Professor.
Response has got to be longer than that. Come on. Go ahead.
But I was saying, like, for one of the discussion boards, right? If we all, let's say I respond to Richard, for example.
Okay, go ahead. Yep.
If our information is the same and we both have the correct answer or the answer you're looking for, I can't go and then repeat, like you get what I'm saying? Like, yeah.
I got you. All right, here's how it works, Mike. Here's the deal. when you respond to one of your peers, your classmates, I'm looking for you to add to the conversation. Okay? Not just repeat what they said, because that doesn't help anyone. The idea behind a discussion board is to talk about the topic, right? Talk about the topic. You can use other resources other than your book. Go hop on the internet and find, some resources to help you out, okay? To answer the questions or to help you respond to one of your classmates. The way that I typically respond to classmates is I'll first say, hey, this is a great post. I like how you identified X. I also found this same conclusion. I found this resource that also went and elaborated on this topic. I found this part interesting. And the other thing I do is I ask engaging questions to your classmates. Say, hey, have you considered this? Or what are your thoughts on this? To help to add to the conversation. Do you see what I'm saying? It's not just repeating what they said, but it's elaborating. Does that help, Mike?
Yes, sir. I got you.
Cool. Yeah, exactly. The whole idea behind why I have discussion boards, in not math class, but in an accounting class. The reason why I have discussion boards in an accounting class is to help you to become more independent when it comes to research and thinking. I want you to become really good thinkers. I want you to think outside of the parameters. I want you to be creative. I want you to think about what we're talking about. And that's really the idea. That's the idea behind it. David, what's up? Got a question?
No.
Okay. All right. I got you. I had to ask. Okay, so that's the discussion board. Any questions on the discussion board? Please try to hop on there by Thursday with your original post, and then get to your classmates by Sunday. Okay, so that's the Chapter 7 discussion board. Chapter 8 quiz, just like the other quizzes, about 5 questions or so. True, false, multiple choice matching. Now you have the midterm. The midterm is going to consist of, well, let's find out. I forget, to be honest. It's been a while since I've seen it. 10 questions. 10 questions. It's worth 10% of your total grade. It's 1 point apiece. 10 questions, 10% of your total grade. Ooh, that's heavy. It is heavy. It's a midterm. So how do you do well in the midterm, you might be asking? If you were successful in understanding the content from chapters 1 through 8, and you demonstrated that through the quizzes, the homework assignments, and the discussion boards, you're going to do really well. Because everything on the midterm, it comes from those chapters, and you'll find very similar questions on the midterm exam that you've seen in previous quizzes. As a hint, you hear what I'm saying? You're all still there?
Yes, sir.
Okay, that's a good hint, right? So if you remember what y'all seen on the quizzes, it's going to be similar questions on the midterm exam. Yeah. So it's open book, open note. Go through the PowerPoints, rewatch some of the videos, look at some of the areas where you had problems. You can always ask me. Right? You could be like, hey, Dr. B, I don't quite understand this concept. Can you help me a little bit further? I'll respond to you as quick as I can. So, okay, that's the midterm. Now, if you have anything past due, you're in trouble, okay? I need you to make sure that if there's anything past due, you get that submitted ASAP, yeah? I cannot allow you to go past the midterm without making sure that all your work's done, yeah? The university will be very upset with me if I allow that. So please make sure that if there's something past due, you need to get that done immediately. Remember, quizzes, you can take those up to 2 times. Homework, unlimited attempts on homework. So if you did not do well in homework assignments, you want to try to do better, retake it. Retake it. If you didn't understand some of the concepts, retake it. If you're like, oh, I want some more practice from those topics, click on the Show Me How button in the homework. That's a fun button. Work through some of the example problems. It's all good stuff. The idea with accounting, remember, practice, 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 practice. Accounting is a practice. Just like law is a practice. Dentistry is a practice. Being a medical doctor, that's a practice. The reason why we call it a practice is because we constantly are practicing, right, to get better at it. That's the idea. So practice makes perfect. Okay, I apologize. I got back in my soapbox.
Professor, I got a question.
Darian, go for it.
I inadvertently, in my haste to complete my assignments, opened my midterm. I'm just wondering if I can get another opportunity to do it over again, being as though it's not due until the 7th.
Yeah, send me an email. I'll let me know what exactly it is, and I'll take a look at it.
Okay.
Yeah, good question. Absolutely. Okay. Anything else? Any comments, questions, or concerns before we call this session over? I know we're like several minutes over, but I had a couple soapbox items. Anything else?
No, sir.
All right. Okay, my friends. Well, listen, I appreciate you spending some time with me. If you ever think of anything, please send me an email. Please call me. Please set up office hours, all that great stuff. And then my plan is after the midterm is over, I'm going to send a survey out. It's a blind survey, okay? So I'm not going to see who said what or anything like that. The idea behind the survey is to help me to improve as a professor. I take your feedback very seriously. If you're like, Dr. B, I want to see more examples. Dr. B, I want to see more video. Dr. B, I want to see more whatever, right? I change my teaching approach based on your feedback. Okay, that's the idea. It's called a mid-semester survey. And it helps me to help to be a better professor to help you. So that's why I like to do that, yeah? So I'll send that out after the midterm, and then we'll roll into the next modules. We only got 4 weeks left, so let's make it a good 4 weeks. All right, y'all. If you're in any trouble, you let me know. If you're having trouble with the textbook, let me know immediately through by sending me an email, and I'll be jumping on the folks at Sungage to get you fixed up, okay? All right, y'all. Thank you so much. Stay safe. Wash your hands. Do the right things. Take care.
See you next week, Professor.
Thanks, Mike. I appreciate you.
Thanks, Professor. Have a good day.
You too, Tramika. Always a pleasure. Take care, y'all.
Professor.
Yes, sir. Yes, Brandon.